Verizon. So we could have talked about almost any of the big international operators, China Mobile, we could have talked about America Mobile, we could have talked about Vodafone in the UK or Telefonica or any of them in the US, AT&T, but we decided to go with Verizon. Why? Simply because they're one of the largest and they're in a very developed market where average revenues per user are above $50 per person. So Verizon is the largest player in the US market. It's also probably got the best network. It's got about 150 million customers. And that is, of course, people who use their various service provider networks, LTE, 5G, fibre optic. It's a New York-based company with its head office in Midtown Manhattan. Market capitalization, $211.48 billion. So that's a big boy.
3 trillion rand.
Yeah, exactly. We'll talk about companies later that are in the billions of rands. This one is worth 3 trillion. Price to earnings ratio just under 15. Dividend yield high at 4.51%. So just your general take on these guys?
So the two big gorillas in the US market is Verizon and AT&T, and then on the wireless side, the two smaller players being T-Mobile and Sprint.
Yep.
And similar to our market, we have two big players and then two smaller players. You have very similar dynamics, which is quite interesting in terms of the two big players trying to be to hold pricing and hold on to their margins, while the small players know they need to lead with price, cut price, and through that acquire more customers. So big tussle happening.
Although Verizon, as I said there, has got like a $51 average revenue per user, which, I mean, one should note is a big number compared to what we think is a good ARPU down here. That's about $10 higher than AT&T, which tells me that Verizon has that position in the market, and I know this from traveling there. It's perceived to be the higher quality network. It's a bit more expensive, but if you're a heavy user and you don't like dropped calls and you don't like 3G signal or edge signal because they forgot to put the tower up, then you're going to go with Verizon.
Correct, and you're willing to pay a bit more, but the other smaller guys are coming with these family plans at roughly $40 per family member, which is putting pressure on them, because then people say, am I willing to pay the $10 extra per person in my family of four for better service? How much better is that service really? And that's what's happening at the moment.
What about the iPhone 7? Do you think it's going to drive significant customer loyalty, or do you think it's going to be a thing where they have to give away incentives in order to get people to sign up for another 2 years?
Well, in the short term, the upgrade cycle, as it is called, does have a negative financial impact, because you do give a discount on these phones and subsidize it effectively as the operator. So in the short term, it's negative. In the long term, it's just people moving around between these different operators, so you're actually shrinking the profit pool. So with everyone now having a phone, in the US at least, a smartphone, a lot of features, the upgrade cycles are getting less important, but the incentives are still there, so a net negative actually.
Let's have a look at the share chart, because it's not bad. It moves in the right direction. It's a bit of a market performer. Remember, it's part of the Dow Jones Industrial Average. It's a very big company. It's got a solid yield. So people have liked it, and they've generally been on the view, I think, that as the US consumer looks okay and the US economy is good and the underemployment levels come down, that it's a good, solid investment. Remember, they spent $130 billion gearing up in order to buy out the minority partner, which was Vodafone and Verizon Wireless.
Yes.
So the combined entity now has got more debt, but it's got all those customers, and it's kind of like got its own destiny now going forward.
Correct. So they made a capital allocation towards controlling the whole of their wireless business. And then secondly, a year ago they bought AOL, and a few months ago they bought Yahoo.
I was going to ask you about that. So what's that about? That's the content strategy.
Yes, they're shifting to say, instead of just owning the dumb pipe, if it does become dumb, let's go into content. Let's own the people who will put the content through our pipes and really generate a lot of activity through more data.
AOL and Yahoo isn't exactly,
not first tier, exactly, to put it mildly. So that's the problem.
Some nice websites, I think. Some
I
high
haven't
traffic
been
sites
to them.
like TechCrunch and Huffington Post, I think, is in there. Those sorts of kind of sites that people go to and have journalistic integrity, at least.
Yes, but I don't think they're looking to make money from the content itself. There's some margin maybe to be made from subscriptions to Huffington Post, but the real margin is to have video, data, high intensity use, to say, if you're a client of ours, you can get this data at a discount, but still that generates more revenue.
You can sign on, and when you activate your internet at home, because you get the triple package,
Triple
you
play,
buy the telephone service, you get the home internet and your home video subscription.
Correct. Either cable TV or satellite.
All in sort of one bill, and then you can make a bit of a margin on it, and this is your portal when you start up the computer to sit down on your couch.
And that's why it's interesting to contrast it with AT&T, which bought DirecTV, and therefore is saying, instead of going into content, let's go into other pipes. So that if one becomes dumb, maybe the others stay smart.
DirecTV is satellite.
It's mostly satellite TV, but also cables,
Okay, the real question at the end of the day with this is hot or not. I mean, with money that you've got outside, would you put this one on your buying list? That's the question I always ask.
So if you look at a stock screen and you're looking for low PE, high dividend yields, Verizon screens as a wonderful company with wonderful metrics, a lot of value and quite cheap.
Yeah.
But it's in a very mature industry. Revenue has turned negative. They've probably tapped out the US consumer in terms of that $50 per user revenue, where I don't think people are going to spend more than that, while your costs over time creep up. So the whole sector for me has got this major issue regarding this a pinch between revenue and margin, and cost rather, a margin pinch. So I'm not a big fan about how mature these industries are and where these companies are in this industry. So I would say even though it has perceived value, not hot.
Okay, I'm going to go with hot because I think there's still more juice there in terms of people that weren't on smartphones before. But I will give you that as far as an international buyer is concerned, we wouldn't put it top of the list because you can own things like Google and Facebook and so on, which seem further up the content curve. Right, anyway, that was an interesting conversation.